Ladies and gentlemen, listen carefully, because if you own something like 500 O's of silver, you are no longer just holding a passive asset. You are participating in a much larger shift that most people still do not fully understand. I am not talking about a minor price fluctuation or a short-term trade. I am talking about a structural change in how wealth is stored, protected, and ultimately repriced when the system itself begins to strain. Most investors believe they understand why they own silver. They think of it as insurance, a quiet hedge against inflation, something that sits in the background while the rest of the financial world continues operating as usual. But that assumption depends on one critical belief, that the system remains stable enough for silver to stay in that passive role. And that belief is now being tested. The real question is not whether silver moves higher next week. The real question is what silver represents when the financial environment itself begins to shift, because history has shown this again and again. Major turning points do not announce themselves clearly. They begin quietly, almost invisibly, while most people continue focusing on the same assets, the same narratives, and the same assumptions that worked in the past. Then something changes, and when it becomes obvious, it is already too late to position properly. Right now, silver is sitting in the middle of that kind of transition. For years, it was ignored, it moved sideways, it frustrated investors. Capital flowed elsewhere, growth stocks, speculative sectors, easy money opportunities. That environment conditioned people to stop thinking about silver as strategically important. But markets do not care about comfort. They respond to pressure. And when pressure builds long enough, the system eventually adjusts whether investors are ready or not. This is not speculation. This is structural. For a long time, silver pricing was dominated by financial instruments, futures markets, derivatives, algorithmic trading. On the surface, it looked like supply was abundant and easily available. But underneath that financial layer, the real world was telling a different story. Demand has been rising steadily, not because of hype, but because of necessity. Modern systems require silver, energy infrastructure depends on it, advanced electronics depend on it. Telecommunications, medical technology, data systems. As the global economy becomes more technologically integrated, silver's role expands quietly in the background. At the same time, supply has not kept pace. Mining output has struggled to grow meaningfully. New discoveries are limited, costs continue rising, political and environmental constraints slow expansion. This creates a condition that markets ignore for, but not forever. Because when demand increases and supply remains constrained, pressure builds, and pressure does not disappear, it accumulates. Now listen carefully, because this is where most investors get it wrong. They expect major moves to look clean and obvious, a smooth trend, a clear confirmation. But that is not how real transitions happen. Real transitions are volatile, they are uncomfortable, they create confusion. Silver does not begin moving in a way that reassures investors, it begins moving in a way that tests them. Sharp rallies followed by pullbacks, conflicting narratives, analysts arguing over whether the move is real or artificial. But the noise is not the signal. The signal is the change in behavior. And silver's behavior is beginning to change. It is no longer acting purely like an industrial commodity. It is starting to reflect characteristics of a monetary asset again. And that distinction matters more than most people realize. Industrial commodities rise when growth accelerates. Monetary assets rise when confidence begins to weaken. And right now, confidence in parts of the financial system is quietly being questioned. Most investors are looking in the wrong place. They are watching stock markets. They are watching interest rate decisions. They are watching earnings reports. But beneath all of that, another signal is emerging, the bond market. For decades, bonds represented stability. Government debt was considered safe. It was the anchor of the system. Investors believed central banks could always intervene, always stabilize, always maintain order. But that assumption is being challenged. Years of low interest rates encouraged massive borrowing, governments expanded deficits, corporations relied on continuous refinancing. Debt accumulated everywhere because it seemed manageable. But debt behaves very differently when interest rates rise. What once looked stable begins to look fragile. This is why volatility in bond markets is increasing in ways that experienced investors recognize as unusual. And when the foundation of the financial system starts showing instability, capital begins searching for alternatives. That shift does not happen overnight. It begins quietly. First, a small group of investors starts hedging. Then, larger institutions adjust positions without drawing attention. Eventually, the broad market begins asking questions. By the time those questions are being asked publicly, the transition is already in motion. And this is exactly where silver becomes critical again, because silver sits at the intersection of two powerful forces. It is both a monetary asset and an industrial necessity. When financial systems weaken, monetary demand increases. When technological systems expand, industrial demand remains strong. Few assets operate in both worlds at the same time. Silver does. And because the market itself is relatively small, even modest capital flows can create disproportionate impact. This is why silver does not move gradually when conditions change. It reprices not slowly, not politely, decisively. If you hold 500 O's of silver, you need to understand what that means now, because ownership is no longer passive. It is becoming strategic. And once that shift happens, the entire conversation changes. This is not about predicting a price. It is about recognizing a transition. You need to understand what is happening beneath the surface, because the shift we are discussing is not just about silver. It is about the structure of the system that assigns value to everything you own. Modern financial systems are built on credit. Governments issue debt to fund spending. Corporations borrow to expand and refinance. Consumers rely on credit to maintain purchasing power. For decades, this worked because borrowing costs remained low and liquidity remained abundant. The system expanded because it could, but no credit system expands forever. At some point, the scale of debt reaches a level where it requires constant support just to remain stable. And when interest rates begin to rise in that environment, pressure spreads quickly, governments face rising interest expenses, corporations confront tighter financing conditions, consumers feel the impact through reduced access to credit and higher cost of living. This is not theory. This is the natural behavior of leveraged systems. And right now we are seeing those pressures emerge. Global debt levels have reached extraordinary heights. Deficits continue even during periods of economic expansion. Central banks are forced into a difficult position. They must control inflation while also preventing instability in the very system that depends on low borrowing costs. Those two objectives do not align easily. Tightening policy helps reduce inflation, but increases stress across debt markets. Loosening supports stability, but risks weakening currency purchasing power. This creates a tension that cannot be resolved cleanly. And when that tension builds, confidence begins to erode. Not all at once, not dramatically at first, but gradually. This is where most investors fail to recognize what is happening. They are trained to look for clear signals for definitive events, but structural changes do not arrive with certainty. They develop through small shifts in behavior that accumulate over time. Institutional investors begin adjusting allocations quietly. Hedge funds increase exposure to real assets. Central banks themselves expand holdings of precious metals. These actions do not create headlines immediately, but they change the direction of capital, and capital movement is what ultimately drives markets. Silver sits directly in the path of that movement. Unlike financial assets, silver does not depend on policy credibility. It does not rely on balance sheet expansion. It does not require trust in institutions to exist. Its value is tied to physical scarcity and real-world utility. That independence becomes increasingly important when confidence in the system begins to weaken. But silver is not only a monetary hedge. It is also deeply embedded in the modern industrial economy. This dual role is what makes it uniquely sensitive to the environment we are entering. Think about the infrastructure being built around you. Energy systems are transitioning toward electrification. Renewable energy expansion requires materials that can conduct electricity efficiently. Silver is one of the most effective conductors available. Solar panels depend on it. Electric vehicles require it. Data centers, sensors, telecommunications networks, and advanced medical systems all rely on silver in ways that cannot easily be replaced. This is not a temporary trend. It is a structural transformation of the global economy. Industrial demand for silver is not driven by speculation. It is driven by necessity. At the same time, supply remains constrained. Mining is not a flexible process. New supply cannot be created quickly. Discoveries take years to develop. Projects face regulatory hurdles, financing challenges, and operational risks. Environmental restrictions add further delays, and much of the world's silver production is tied to the mining of other metals. This means supply cannot respond rapidly. Even if prices increase, demand can rise quickly. Supply cannot. That imbalance creates tension inside the market. And when markets experience sustained imbalance, they eventually reprick to restore equilibrium. Not gradually, but forcefully. Now consider the scale difference between silver and the broader financial system. Global equity markets represent tens of trillions of dollars. Bond markets represent even more. Institutional investors control massive pools of capital that require allocation decisions. The silver market, by comparison, is extremely small. This creates a condition where even modest shifts in capital can have an outsized effect. It does not require a massive global consensus to move silver significantly. It requires only a change in attention from a relatively small portion of global capital, and attention is beginning to shift. This is why silver has a history of sudden powerful moves. It remains quiet for long periods while conditions build. Then when capital begins flowing in, price adjusts rapidly. Investors who wait for confirmation often find themselves reacting too late. They chase movement instead of anticipating it. This is where perspective becomes critical. If you own 500 O's of silver, you are not simply holding a metal, you are holding exposure to a system in transition, and transitions are not smooth, they are volatile. Volatility creates doubt, it creates hesitation, it forces investors to question their decisions. But volatility is not always a sign of weakness. Often it is a sign of change. Periods of calm reflect stability or complacency. Periods of turbulence reflect adjustment. Markets moving from one equilibrium to another do not move in straight lines. They move in waves of uncertainty. During those waves, ownership changes hands, short-term participants exit, long-term holders accumulate, institutions build positions gradually. The character of the market shifts from speculation to conviction. Silver has followed this pattern repeatedly. Long periods of neglect, followed by sudden attention, followed by rapid repricing. And each time the explanation seems obvious after the move has already occurred, but the conditions that created those moves were visible long before. They were simply ignored. Today, many of those same conditions are present again. Debt levels remain elevated. Monetary policy remains constrained by competing objectives. Inflation pressures continue influencing policy decisions. Governments rely on continued borrowing to sustain spending. Each of these forces pushes investors toward reconsidering how they protect wealth. Silver is part of that conversation not because of hype, but because of its position inside the system. It reflects deeper forces. And when those forces begin to align, the impact is rarely subtle. This is not about predicting a specific outcome. It is about understanding direction, and direction, once established, tends to persist longer than most investors expect. Now, you need to take this one step further, because understanding the structure is only part of the equation. The real shift happens when perception changes. Markets are not driven only by data. They are driven by belief, and belief, once it begins to move, can reshape the entire financial landscape faster than most people are prepared for. For a long time, investors operated within a simple framework. Governments issued debt, central banks stabilized markets, bonds provided safety, equities provided growth, precious metals existed on the sidelines, rarely necessary, mostly ignored except during moments of extreme stress. That framework worked because confidence held, but confidence is not permanent, it is conditional. And when the conditions supporting that confidence begin to weaken, behavior begins to change. Not suddenly, not dramatically at first, but gradually investors begin questioning assumptions that once felt unquestionable. They start asking whether the system can continue functioning the way it has. They begin exploring alternatives, not out of panic, but out of necessity. And once that process begins, it rarely reverses quickly. Look at the signals forming across the global economy. Debt continues expanding across developed nations. Fiscal deficits remain persistent, even during periods of growth. Central banks are navigating a difficult balance between controlling inflation and maintaining stability. There is no simple solution to this. Tightening policy introduces stress. Loosening policy introduces inflation risk. Every decision carries consequences, and investors are beginning to recognize that reality. This recognition changes behavior. Institutional capital does not wait for headlines. It moves quietly. It irrelates gradually. It positions before the broader market fully understands what is happening. And when enough capital begins moving in the same direction, the effect becomes visible. Silver is positioned directly within that transition. It is not just a commodity. It is not just an industrial input. It is not just a hedge. It is a signal about the health of the monetary system, a signal about confidence in currencies, a signal about how investors are responding to structural pressure. And signals like that do not appear randomly. They emerge when underlying conditions begin to change. Now consider the psychology of markets during these transitions. Most participants do not act early. They wait. They look for confirmation. They rely on consensus. But by the time consensus forms, the opportunity has already shifted. Early stages are always uncertain. They feel uncomfortable. They lack clear validation. That is why most people hesitate. But hesitation has a cost, because once attention returns to a neglected market, capital follows. And when capital flows into a small market with constrained supply, price movement accelerates. This is why silver does not move in a predictable, gradual manner. It moves in phases. Long periods of quiet accumulation followed by sudden bursts of activity, followed by volatility that test conviction, followed by continuation that surprises those who hesitated. And this cycle is repeated multiple times throughout history. Each time the pattern is the same: neglect, accumulation, recognition, repricing. The only difference is the scale. And the scale today is influenced by a global financial system that is far larger, far more interconnected, and far more dependent on continuous expansion than at any point in the past. That matters because when imbalances form inside large systems, the adjustments required to correct them are rarely small. They tend to be significant. Now, if you own 500 of silver, the implication is clear. You are not holding something insignificant. You are holding an asset that exists outside the promises of the financial system, an asset that does not rely on policy decisions to maintain its existence, an asset that participates in both monetary protection and industrial demand. That combination is rare, and rarity matters when conditions begin to shift, but you must also understand this. Ownership alone is not enough. Understanding is what determines how you respond when volatility increases, because volatility will increase. That is not a possibility. It is a certainty. The real question is how you interpret that volatility. Do you see it as instability, or do you recognize it as transition? Do you react emotionally, or do you remain grounded in the structure you now understand? Because this is where most investors fail. They understand the thesis during calm periods. But when price begins moving unpredictably, when narratives conflict, when uncertainty rises, they abandon their position at the exact moment the cycle begins accelerating. And that is how wealth transfers occur. Not through lack of information, but through lack of conviction. Those who understand the cycle early position themselves before the shift becomes obvious. Those who wait for confirmation arrive after the move has already begun. And once momentum builds, it rarely slows to accommodate late participants. This is why I am telling you to pay attention now. Not because of a headline, not because of a short-term prediction, but because the structure is changing. The environment surrounding your ownership is evolving. And when ownership of silver transitions from passive to strategic, everything changes. This is no longer just about diversification. It is about positioning within a system that is under pressure. It is about recognizing that cycles do not last forever. It is about understanding that when trust begins to weaken, capital begins to move. And when capital moves into assets like silver, the response is rarely gradual. It is decisive. The real question is not whether that shift will happen. The real question is whether you will recognize it early enough to understand what it means for your wealth. Because by the time it becomes obvious, the re-rising is already underway.